Welcome back to CEO Money. I'm Michael Yorba. All right, we are talking with Gaurav Chakravorty, CIO and founder of Qplum. Gaurav, welcome to the show.
Thanks for having me.
My pleasure. All right, you are the co-founder and CIO of Qplum, which is an asset management firm that offers AI-based trading strategies. Tell us a little bit of your background, and then let's go on into how you're taking advantage of this big wave of AI that's coming and pervasive everywhere.
Sure. So I learned about AI at the University of Pennsylvania, where I was doing a master's in computer science. And there, Dr. Steele inspired me about using this in financial markets. I joined a small Wall Street firm where they, just gave me about $10,000 and asked me to try my luck with it. And I made more than $700 million of profits from that and built a team, 50 engineers. And all this was not because I was smart, but because this method worked, because, AI and machine learning worked. And since then I started my own company, and just to use the same approach, but to make these strategies more widely accessible.
Now, the trading strategies, were they high-frequency, short-term, or were they investment strategies, or all the above?
Exactly. You're spot on that when I started, what we initially developed was what we would call today high-frequency trading. Back then, it didn't have a name. This was 2005. It was just called trading. But I agree with the industry. And what happens is when you use something like AI, something like machine learning, you have to use a lot of data, and the opinions change a lot. So it is a higher trading approach. But at Qplum, we have sort of used the same AI philosophy across the board for even long-term investors.
I tell our investors who are listening to the show how investing has changed over time from where we used to be and where we are now, and where do you think we're going to go?
Very good question. I think that investing is changing very fast, and I think investors sometimes sitting at home don't realize that. And take the opportunity to say that in future we won't be trading in front of, we won't be going to our brokerage account and buying and selling stocks. Investing will become a technology business. Asset management will become a tech business. So much so that I think just like we use, Google for information retrieval, we don't ask our friend, hey, I'm going to Chicago, can you tell me a good restaurant there? We search Google, Yelp, etc. We rely on technology in other parts. We'll start relying on technology in investing.
Do you see that we would be able to absolutely guarantee ourselves, and the G word in investment should never be used in the same sentence, but we can absolutely guarantee ourselves of some of the negative things that have occurred already by using AI, like all of a sudden all the trading signals get hit, everybody who's using AI to trade with, and we get a vacuum effect of a flash crash. We've dealt with this already.
I think exactly what flash crash was about something else was market microstructure. But I think the real negative effects that I feel investors should watch out for are things like human biases, fear and greed, which drives market cycles. And what we are trying to achieve, and others like us are trying to achieve with AI, is just a systematic approach that a person can look at it carefully and say, you know what, I just cannot do better than this. This is what I would do if I were a complete rational self.
Well, you being able to take $10,000 and turn it into $700 million, by the way, over what period of time, is phenomenal. I mean, that's like, I've been doing in the investment world since 1980, and I've never heard of that kind of move.
But that's in the past. That's not the sort of, and that was when the industry was just growing. I think I was lucky, but also it was at the time the opportunities were there because the technology was new. Okay,
so there was a lot of room for you to be able to exploit the inefficiencies of a system through AI. I get that. All right. What other parts of computer science are needed to build an AI-based firm?
Very good point. So, earlier a portfolio management firm would be, like, let's say, 2-3 people in front of a Bloomberg screen, but all that's changing. When you look at a technology firm today, an asset management firm today that is using AI, you need a lot of people doing computer security, doing cloud, working with servers on the cloud, using big data and DevOps. Just it's the same engineers that you would find in a Google or Facebook that you would find in an asset management company.
Okay, you've already broached the topic about being able to move from human-based traders into AI traders, but what are the risks of investing with AI?
Yeah, I would look at risks on two sides, one from the side of investors and the other side of the companies that are servicing the investment. So investors need to really understand that there's a machine out there. They need to stop second guessing. They need to stop trying to figure out, can I do better? And they need to be kind of patient with the technology. And on the investment side, the asset management side, I think computer security is a big risk. Mm-hmm. And as a technology company, our biggest risk is always just software bugs that, you got to make software that works flawlessly. And that's why I think, I've been doing this for 12 years, but if you use a company that does not have enough software development experience, that would be the biggest risk.
Okay. What are the biggest business drivers behind the adoption of AI?
AI is about providing the highest quality of investment strategies at the lowest cost. I cannot emphasize more, but costs are a big driver. If you go to institutions, if you go to individual investors, everybody is talking about being judicious, with expense ratios, et cetera. And if you ask somebody, provide me the best strategies out there, but at the lowest cost, you need AI.
Okay. Difference between quant and data science-based approach?
So quant is this old school method of using mathematics, financial, stochastic calculus, where you make models to explain the world. And you have a hypothesis, and you sort of validate that. That's based on a lot of mathematical talent, basically. But data science is about using all the data there is. In quants, they ignore most of the data. But data science use all the data that they can get and use a very machine-first approach. They don't use their hypothesis. They don't use their ideas. You don't need to have any. In fact, anybody in our company, we make sure that they are not from a finance background. We make sure that they don't use their intuition.
Gaurav, I'm sorry that we got to cut it off here because this is definitely a topic, but I want to follow up with you later because this is really something that we're opening up here with our own show, our own marketing, our own sales. So please accept my humble...
that's cool.
Thank you very much for being the guest on the show.
Thank you. Thank you for having me.
You're welcome. Gaurav Chakravorty, CIO, co-founder of Qplum. That's QPLUM.co. You've been listening to CEO Money with Michael Yorba, Ed Baxter. Thanks for tuning in from Dallas to Tel Aviv. We appreciate all of the news and the letters that's coming to us.